Okay, so let me start then. Now you should see the screen with the bonds written on it. After having the classes where we discussed the basic theory of calculating the cash flows, NPV, internal rate of return, annuities, and so on, today we start with the next logical component of the course. Where we'll discuss two main types of securities which are issued and which are available for you to purchase or for many companies to issue. And we start with the bonds. Next time we will talk about the stocks. And by the way, I think next week or at the beginning of the week after the next one, we will announce the homework. We will upload it to Smart LMS. You will have a chance to read, to look through it and ask your questions, because it will be based on the calculations of the risk and of the return on the portfolio of the stocks. But we go step by step, and principally the bond is more simple type of securities compared with the stocks, and we will start with that one. And during the lecture you will see that the material that we discussed today is to the big extent is based on the topics we discussed with you on the previous lectures. This is also based on the cash flow calculations, the present value, annuities, and these types of things. So everything is very much related. And if you haven't got that part yet, please accelerate. Otherwise, you might lose the understanding of the things we discussed here. But if you understand this present value part, then this would make a perfect sense to you. What we will discuss today, we will discuss, first of all, we will start with the definition of bonds. Then we will discuss how to estimate their value, how to estimate their return. And there are two main factors affecting their return of the bonds. This is the interest rate risk and the default risk. And based on those two risks, there are multiple factors that we should consider affecting those risks, and we will cover that. And this is the way how we estimate the bonds. And by the way, currently we are going through the unusual situation on the Russian bond market. You might heard from the news that last week there was a rumors that one of the state-owned firms, Rosnana, had the chances of default, which substantially affected the Russian bond market, Russian security market in general, combined with the general trend of withdrawing the money from the developing markets. It resulted in unusual situation that we'll discuss in a subsequent part of this lecture today. So things that we will cover, they're very much applicable to the everyday situation. And if you are involved in trading, some part of your portfolio should be in bonds. At least this is recommended, to split your portfolio by multiple components. And this is also why we believe this is a relevant thing to understand. So let's start with the definition of the security. Bond, in Russian we would call it obligatsiya. The bond is a security that obliges issuer to make the specified payments to the bondholder. So in principle, in its essence, the bond is a type of the loan agreement, just compared to the loan agreement that can be made between you and bank. Just when you borrow money from the bank with a loan, this part, so issuer of the bond, the company that wants to borrow money, can issue special types of securities, and those types of securities will present obligation of this company to pay money back. And the bond has multiple characteristics. Which are the face value, coupon, and relational one of those two coupon rate. The face value of the bond is the principal amount of how much money is borrowed. This face value, it cannot change over time. It is written, if the bond is issued in paper, it would be written on the bond itself. This face value would be written there. For example, 100 rubles, so $100, or 1,000 rubles, wherever. And it cannot change over time. And as this is kind of borrowing, the borrowing shouldn't be free, and issuer of the bond, for having opportunity to use this money that issuer uses, has to pay coupon, so has to pay interest on this money that were borrowed. And this interest, in this case, is called coupon. In order to remember it, let's look at the picture of the bonds. We have two of them here. This is one, and this. So this is from United States, some historical bonds of the 19th century, and this is one from the Soviet Russia, and both of them are similar in its essence. So let's take a look at them. This is here. This is face value is written here. So the face value of this bond is $5. So you can pay some amount around $5 and purchase this bond. And each half a year, so you see August 1st, 1884, February 1st, 1885, August 1st, 1885, and February 1st, 1886. So twice in a year, you will be eligible to receive a coupon on this bond. So you will be eligible to receive 7.5 cents for each face value, $5 of the face value of your coupon. And in old time, how you would receive those coupon payment, you will just slice the part with this coupon, like people did here. You see there are already two coupons were paid here. So you slice one coupon, bring it to the bank, and bank would pay you this coupon amount. And this is why interest on the bond is still called the coupon, even though these days we mostly do not have bonds in paper. We purchase them electronically. Still, the terminology remains. So the face value, something that is written on the face of its bond. Alternatively, the face value is also called the par value. No, those are the synonyms. And the coupons are the interest paid on the bonds, to keep this historical analogy of these physical coupons that people used to cut off the paper of the bond and bring to the money in order to bring to the bank in order to receive the money for it. And the coupon rate is the annual interest payment as a percentage of the face value. So here coupon rate would be written on the bond itself. So for example, here we see that it is 2% coupon rate. Is a ratio between the coupon, annual coupon. So if there are multiple coupon payments per year, this would be the sum of all coupons divided on the face value of the bond. Yeah, so here we see this is 200 rubles, and the coupon here is paid once a year, and this is 4 rubles. So 4 divided on 200, it is 2%. And this is the coupon rate. So those are the main characteristics of the bonds. And all those characteristics, please remember that the face value, the coupon, and the coupon rate, they are fixed. They cannot change over time. But there are some characteristics that change over time, and they affect the return that we would have on the bond. And we are about to discuss those characteristics. Bonds can be issued by companies, by states, by municipalities, by some sovereign government organizations, and their main objective is to receive additional financing to support, to finance some activities of the state. So, for example, if states needs more money for anything, the state can issue the bonds. If municipal or some region, for example, St. Petersburg region or Khanty-Mansiysk region or wherever region, or some state or wherever needs additional financing, they also would issue the bonds. General public or some institutions will be eligible to purchase those bonds and receive the coupons on the bonds they purchased. And those who purchase the bonds, they are creditors of the issuer. So again, let's keep this in mind. So if you issue the bonds, in other words, we can say that you want to borrow the money. So you will borrow the money from someone who will agree to purchase your bonds. And important thing then we work practically with bonds, as the bonds are traded publicly on the market, you might purchase the bond before its ending period. So the loans, they have some term structure, they have some time when loan will be eligible, and this period for the purposes of the bonds is called the maturity period. So the period until which the bond is effective. And if you make the transaction between the issuing of the bond and the maturity period, someone purchased the bond and then you want to purchase this bond yourself from the current holder of the bond. Apart from the current price of the bond, you will also have to pay accrued interest on it. Accrued interest is the compensation for the coupon that is already earned but not yet collected. So let's going back to this example. So the payment here is every 1st of the January each year. But let's say you purchase the bond on the 30th of the June, so in the middle of the year. Then it would be fair if you additionally pay back to the person who sell you this bond 2 rubles out of this 4. So as the half of the year passed, the person is already earned 50%, so half of this annual coupon. So you will pay these 2 rubles. And this is called the accrued interest. So, for example, then you would deal with bonds on the open market through your investment application in the smartphone or computer. Please beware that when you purchase the bond, you also would pay this accrued interest. In the seminars, you will have a practical calculations how to do it, but the essence is very simple. So this is the fraction of the period for which coupon is already earned but not yet paid. Going back to the basic part, so how we estimate the price of the bond. As the bond there is some face value, so something that is written on it. But depending on the current market situation, the price at which you can purchase it on the open market would vary. And in order to estimate, we again would use the formula, which is already familiar to you. This is a present value formula. This is it. So this is the present value, the market value of the bond, the coupon payments, and par value. Par value is the face value of the bond. We discount them at the appropriate interest rate to receive its present value. And this would be the value of the bond. This general formula can be broken down into two parts. As we have the set of equal payment with the equal intervals, the coupon payments, we can multiply the coupon on the present value of annuity factor in order to find its present value. And then at the end of the bond's life, at the maturity period, we'll have a single payment of the face value, and we can multiply it in appropriate discount factor. And this is the same formula as the one we just saw on the previous slide, just breaking down into two parts. Let's consider the example. There is a French bond, and they pay interest in euros, and the bond is issued in euros. The coupon is paid annually, once a year. The face value of is 100 euro, and the coupon is 8.5%. The coupon can be either stated as a fraction, so we would call it coupon rate. It can be put in the percent, or directly in the money term. This would be the same. If the face value is 100, they would be identical. Bond issued in 2008, and it matures in 2012. How we would estimate its price, taking into the account the current interest rate? Let's take a look. Again, we use this principle of the opportunity cost of capital, and we compare this bond with other types of securities which have the similar level of risk. We find out that other medium-term French government-issued bonds offer the return of 3%. Then we would use this 3% as a discount rate in order to estimate the price of the bond. And this would be the formula. So this is the coupon in 2009, coupon in 2010, 11, and in 2012, we would receive coupon payment plus the face value of the bond, and we discount at the 3% interest rate, and this is how we would estimate the present value of the bond, aka the market price of the bond. So this should be the price at which the bond would be available for purchase on the open market. We discussed with you that we can apply the annuity formula here, and this is how we would do it. This is the same thing that we have here, just we applied this formula. And the bond can be issued for 20, 30 years, for a very long period. And for the sake of saving time, we can apply this formula. Instead of having multiple similar cash flows, we can use the present value of annuity factor formula. There are again two components, component with a coupon and component with a face value. And the results are the same. Now, if we transform the question vice versa, and this it would be very important to transform this question, because on the open market, the bonds are somehow traded, and you can purchase it and with the varying price. So the market price would vary, but at the same time, the coupon and the face value, as we discussed, they are fixed. So the return that you would have from this bond, if you buy it and hold it until maturity, would vary depending on the current price at which you would purchase the bond. And this total return that you would get if you purchase the bond now and keep it till maturity is called the yield to maturity. And how we would estimate it? We transform the exercise. So this is yield to maturity is the way we estimate is the same as the one we use. Then we estimate internal rate of return, but instead of 0, here we would have market price of the bond, the current market price of it. So we can put here the price that we found out in the market and estimate the average return that we would receive till maturity. This is called the yield to maturity. And again, this is return that we will have if we keep it till it matures. Alternatively, we can buy the bond and sell it before maturity, but in that apply different formula that we will discuss later on. But these characteristics of the bond, yield to maturity, is the one that is always published together with it, and it reflects how profitable the bond is, how much money you can make currently with this bond. And if you are following some Bloomberg or some RBK, Kommersant, Business FM, or wherever you are following, they would put some financial news in this way. The yield to maturity of the bond went up. So it looks like something good is going on, but actually it's the opposite is the case. So if the yield to maturity goes up, it means that the market price of the bond goes down. So there is some negative effect. So it means that the bond became less attractive and the yield to maturity increases. So the lower would be this number, the market price, the higher would be the yield to maturity. It makes a perfect sense, I would say. If you have an opportunity to purchase something with a fixed set of cash flow that it generates, the cheaper you purchase it, the higher would be the return. So far, we consider the case when the coupon is paid only once a year. But many bonds have multiple coupons per year. It can be twice per year, 4 times per year, or monthly, okay, 12 times per year. And we should consider it, and it would modify our calculations. So the more frequent coupons are, the better the bond is. So you would, as you remember from our earlier parts, that the sooner cash flows are the better cash flows. And if instead of receiving money once per year at the end of the period, if we receive the same nominal amount every month or less frequent every quarter, it is the present value of the bond would be higher in that way, keeping other things equal. So here what we had, you see here we have a present value of the bond equal 120.44, but now instead of annual coupon, we have semi-annual coupon, so the coupon is paid 2 times per year. And keeping all the things equal, we will have the higher market value of it. How we would approach this exercise? The coupon just divided on the number of periods. As we're talking about the semi-annual coupon, we divide 8.5 that we had in the previous exercise on 2, having 4.25. Here also we should modify the discount rate that we work with. Here we would use how this type of conversion is called. Who can remind? So we discussed 2 types of interest. Maybe someone can remind us how this one is called.
This is the effective annual interest rate.
Yeah, yes, Ivan. So this is effective, but it's if we would do it opposite, it would be effective annual rate, but we do from annual to semi-annual.
Oh yeah, so it's using compound interest anyway.
Yes, yes. So this is the appropriate term that you remembered regarding the effective annual rate. And in this case, effective annual rate deals with the compound interest. And here we would use that because we assume the compounding. So as you receive the coupon, you, as a rational investor, you would reinvest this somewhere to have extra money on it. And that is why we would work with the compound interest procedure. Again, the same formula, but what we changed here, instead of 4, now we have 8, because the number of periods increased. So even though this is still for years, but as we go from annual to semi-annual, we count in halves of the years, and there are 8 halves of the years in 4-year period. And due to the increase in the frequency of payments, the present value of the bond went up. If we would go from semi-annual to monthly, the present value would even increase even further. And this is something that we understand directly from the present value principle. The sooner we receive money, the better. And if we split the amount by smaller parts, we receive this amount sooner, effectively. And as a result, the present value of such security goes up. Here is the historical return on the bond market. So, by the way, this is the source of the statistical data. So for the global statistical data, I will use materials from this source multiple times today. I want you to know it. Here is the link. So this is the, maybe someone knows, by the way, what is that? This FRED, what it stands for, what is that? Has someone heard of that before?
Federal Reserve economic data.
Yes, yeah, no. Who issues it? Which country is that? What it works with?
United States.
Yes, yeah. This is the Federal Reserve is the United States, central bank in the United States is called Federal Reserve due to its distributed system of organization. It includes multiple banks that control the monetary policy of US. And Federal Reserve data system, this is the website where statistics for the macroeconomy, for indices, for the commodity prices, for inflation, and for bonds, for many other markets is collected, and this is very convenient website where you can collect information regarding the global statistics, not just for US, but for many countries worldwide. They accumulate data from multiple sources, including World Bank, OECD, and national statistical bureaus. And you can get data from there if you want to do something. For example, in finance, there is a lot of data available for you. And I took the data for the state bonds issued by the United States with a 10 years maturity period. And here in black, or excuse me, in gray, it is highlighted the crisis periods that took place in US. So there is this dot-com bubble, financial crisis of 2008, 2009, and the recent financial crisis that we had due to the COVID pandemic. And you see each time during this crisis, there were sharp movements on the bond market. The interest rate on the bond usually went down. Why it happens? Because the treasury bills, or treasury bonds in this case, yes, treasury bills is not appropriate term to call 10 years bonds. Treasury bills is state bonds of US with a short term, so usually up to 1 year. And treasury bonds can be bonds with longer maturity. So 10 years, we should call them bonds. And you see then there are some crises, particularly recent crisis. The interest rate on the bond went down. Maybe someone, by the way, has ideas why it is so. Why would interest rate on the bond went down in the crisis of the bonds in the United States? No, then let's go. Did anyone wanted to answer? Please.
Probably because crisis government can make less money and companies make less money, so why they are paying less too. Or because of the recession.
Because of the what? Because of what?
Because of the recession happened.
Recession? Recession?
Yes. Yeah, that one.
No, yeah. This is because of the recession. But you remember when we talked about the yield to maturity 10 minutes ago? I told you that if the interest rate, so the yield to maturity, when it goes up, it means that the price of the bond went down. And the basic principle why recently it was the case then during the crisis, the yield on the bond went up, it usually works like that, particularly on the bond of the US. If we would look at the chart in Russia, we wouldn't see this picture. It would be opposite. But treasury bonds of US, treasury bonds of some other countries, but probably US the mostly, it is considered as the safest security globally. US never had a defaults, and the chances that something could happen with the security, they are quite low. And during the crisis, then stock prices mostly goes down. The investors, they look for safer investment opportunity. And that is why they would go for the treasury bonds. And as the demand on the treasury bonds goes up, the price of these treasury bonds goes up as well, and consequently the yields of the bonds went down, because as we discussed with you, there is only market price changes. The coupons are fixed, the face value is fixed, but as the market price changes, the yield to maturity would change as well, and they change in opposite direction. If the market price goes up, the yield to maturity goes down, and here we see it. And the closer we come to our time, the more strong this effect would be, because earlier in 70s and in 80s, the US were not considered the safest country for investment in that period. But currently they are, and that is why we would see this effect every time some crisis takes place. At least now, maybe in 20 years, there will be some other region that would outperform in the perception of safety, but so far it is like that. And going back to the principle that I just discussed with you, let's consider the example. You can replicate it with your spreadsheets just to understand the idea. We consider the bond with 3 years and maturity period, face value of 100, 3 coupon payments. And we estimated present value at the different discount rate, at the different yield to maturity. And you see that the lower the yield to maturity, the higher would be the bond price. The higher the yield to maturity, the lower would be the bond price. This is something that you should, first of all, understand, and then it would be easy to apply this principle. Again, if the bond became more expensive on the market, so the bond price is this one. So we purchased the bond for 130, having $10 of coupon, $100 of the face value. Then the yield to maturity, the return that we get if we keep it for 3 years until maturity is 5%. If the bond price on the opposite became cheaper, then our return would be higher, because we received the same cash flows paying cheaper initially. And if the yield to maturity equals to the coupon rate of 10%, here the coupon rate is 10%. Then the market price would be equal to the face value. Does it make sense to you? This is probably the main idea of this class. I hope that it is clear to you how it works. During the seminars, you will have a chance to practice it, but so far, again, just keep this in mind, as we have some components of the bonds that are fixed, but so the cash flows that bond generates are fixed, but the market price varies, and as a result, the yield, the return on this bond varies as well, and they vary in the reserve direction, the yield and the market price. Right, so here we have the same chart, the same idea in the graphical form, and the longer would be the maturity period, the more sensitive the bond would be to the changes in interest rate. And here, if we look at this issue from the other side, here we identify one of the main types of risks for trading the bonds. as the bond price depends on the interest rate, so the interest rate would be very important risks for bonds. There is a interest rate, so this is net interest rate issued by the central bank, and when it goes up, the bonds depreciate, their price goes down. So if the interest rate in the country changes, it inevitably affects the prices of the bonds. It inevitably affects the market of the fixed income. So it is fixed income market is its other name for the bond market, and it is very sensitive to that, as we have a so eventually the interest rate for the same for the similar instrument would be balanced. But what if you, instead of keeping the bond till maturity, if you want to have it for some shorter period, what return you would have in that case? Such return we would just call the rate of return, and the way we estimate it is the same for all types of securities. The principle is the same, just the types of cash flow that it generates would be different. And the principle is presented here. So there is a total income that we would receive from having a security in nominator divided on the investment that we make in order to purchase this security. In other words, this current price of the security. So in order to purchase it, we have to pay the price, and we can also call it investment. What income we would receive having the bond? The income would consist of the coupon income and the price change. So we might purchase the bond cheaper and sell it at the higher price. Then this capital gain price change would also be component of our income. But the price change can be negative. If we purchase a bond at the higher price, then it later became, then the price change would be negative, and it can be the case that the return on the bond would get negative if the bond depreciated stronger than the coupon income that you receive for this investment. This is example here. The information, the prices here are taken from the financial crisis period, and they are not very typical, but this is sometimes you can make even such returns on bond, but usually they are much lower. Please keep this in mind. Bond increased in price from 963.8 to 1,380.5. And there is a coupon that you received during this period. What is the rate of return on this investment? We have the same principle. This is the coupon. This is the change in price. This is the capital gain. And this is the return for this period. Again, this is stronger, this is higher return than it usually takes place, but this is here we have a situation from this part. Yeah, this is it. So you see the yield went down. It means that the price of the bond went up substantially, and we just considered that case here in this exercise. And in that period, if you are lucky enough to invest in bond in advance, you might have superior return from rather conservative instruments. And as we just discussed, the interest rate is a very important source of risk for the bond. we should somehow estimate the sensitivity of the bond market price to the changes in interest rate. And in order to do that, we use the duration. Duration is the average time to each cash payment of the bonds. The higher the duration, the more sensitive bond would be to the changes in the interest rate. And in order to get more precise estimation, we would use the modified duration. But let's start with a simple one. What is the principle here? This 1, 2, 3 is the number of periods. So first period, second period, third period, and so on till the period 3. Present value of the coupon payments, they're here, so discounted coupons. And PV is the total present value that our bond would generate. And in principle, this is a weighted time of the cash flow, of the cash flows that bond would generate. So duration is estimated in the units of time. Please do not confuse it. This is a common mistake that students made. Duration is estimated in time units, years, months, days, because this 1, 2, 3, 4, this is the number of periods, probably years in this case, but it can be other periods depending on the frequency of coupons. And we multiply them at the weight of this payment in the total present value, or the fraction of this payment in the total payments. And the bigger would be the fraction of the weight that we receive sooner, the less sensitive bond to the changes in interest rate. And modified duration is it's transformed one. We divide it at 1 plus yield. This modified duration is already measured in percent, unlike duration, which is measured in the units of time. And modified duration can be good for the prediction of the change in bonds price resulting with a change in interest rate. Let's consider let's consider the example how we estimate the duration. We will go through 2 examples here. There is a 1,000 face value and 100 coupon, discount rate of 5%. This is a present value that we would estimate. The total present value 1,146. Then we would estimate the fraction of this payment in the total present value. Here it is. You see the bigger fraction would be at the last payment. No, this is reasonable because it includes the face value. And final column where we would multiply this fraction to the number of this period. Finding the sum of those money will provide us with a duration estimation. You see that the maturity period is 3 years, but duration is shorter, and duration cannot exceed the maturity period if the bond has no coupon, if there is only a single payment of the face value. In that case, duration would be equal to the maturity period, but duration would never exceed the maturity period. Alternative exercise to estimate the duration, and here we would also estimate the modified duration. Here it is, coupon par value, which is paid once, discount rate of 4%, present value of this, then we would divide 86.54 on 1300.1, and we would have 0.07. Do this again and again. Here I rounded these numbers. There would be multiple other decimal places here I'm missing, but if you do it in Excel, they will be taken into the account. Then here we multiply this number to the number of periods and estimate the duration. Then next step is to estimate the modified duration that we would have after we divide it by 1 plus interest rate, the one that we used for discounting. And here what we can do. So if we have market price, how we would use modified duration. If the yield to maturity goes down by 5%, so instead of 4, we will use 3.5 for discounting here. The result would be this one. And if we multiply 5.47 on 0.5%, we would have this the amount which would be close to this number. So this 0.5 on 5.47 is something like 2.73. Yeah, so the actual change is very close to the one that we estimated using the modified duration. Yeah, so again, we have a change in interest rate, which is 0.5%, multiply on the modified duration, and we use it for the prediction of the change in bond price that we would have if the interest rate on the market would change. And here is the actual change, and we compare it against the one we predicted with modified duration, which would be this 2.73.574. And you see that this is quite close, and we can use it to estimate the effect of change in interest rate on the bond price. The reaction of the bond to the change in interest rate might be different in different time periods, in different maturity periods of the bonds, and it is like there are some special terms that we should mention here. The spot rate is the actual interest rate that you can find on the market today. At the current period, T0. Now, the forward rate is the interest rate fixed to date on the loan that would make in future the fixed time. So we might have a forward loan agreement that we would make some loan in a set in some time in the future, but the time and the interest rate is already fixed in this forward agreement. The forward rate, the future rate is the forward rate. It is a formal representation of the future rate, which is the future rate is our expectation of the spot rate that would be in place by the time that we want to make this transaction. And the yield to maturity is something that we already discussed with you. Internal rate of return on the interest-bearing instruments. This is a broader term for which would include the bonds as well. And yield to maturity might vary for the different types of securities. And here I took the chart from the Moscow exchange. I took it yesterday, and you see this is now, as we have a unusual situation on the bond market, this shape of this curve is abnormal. If you borrow money short term, it would be middle term, it's something like 3 years, around 3 years, you would have higher return on the bond compared with the one you would have if you would borrow for the longer period. So if you purchase the bond for 17.5 years or for 20 years that have maturity in 20 years, the yield to maturity would be lower than the one you would have if you purchase it for 3 years. Yeah, and the difference is something like 0.5%, which is a big difference for the bond market. And this is due to the increase in the riskiness of our market recently, due to the case with the Rosnana, that last week there were rumors that it might go default. Fortunately, it didn't happen, but as Rosnana is state-owned firm, and the rumors that state-owned firm might go default, they are very negative for the total bond market. Also, there are some monetary factors involved, and now we go through unusual situations. Then I showed this chart to the student last year. The shape of the chart were mostly it was upsloping. The further we go, the higher the interest rate became. And this is a normal situation, but now this is abnormal. But if you inspect it later on, it should stabilize again. And as there are different terms, so if you go for the market to purchase the bond, you will have multiple options. Some bonds mature soon, in a year or even less, and you can purchase them. Others would mature in 4 or 20 years, like this. Each combination of dots here represent the different bonds that are available on the market in Russia. And there is a so-called the law of one price. That means that all instruments with the same maturity period and with the same level of risk should have the same price. And here, it is represented here as for different time periods, for 1 year, for 2 years, for 3, for 4 years, would have different spot rates. And if like each component of the bond, so we have a bond A for 2 years, bond B for 3, bond C for 4, and if we would take any of those bonds just for 2 years, the total return we would have would be the same. If we would take any of those later 2 bonds for 3 years, we would also have the same return. So as the interest rate on the market would affect all bonds, it should result in the same level of return that those bonds would generate, assuming that they have the same level of risk. Yeah, and the bond would adjust to the current situation on the market by the changes in the interest rate. So let me ask you, so if on the market the interest rate went up, what would happen to the bonds market price? What would happen to it?
So he'll go down?
Yeah, so the interest rate goes up, then the bond price goes down. Yeah, thank you. So this is a reaction of the bond market. And this reaction should balance the situation on the market for the instrument with the same level of risk. And there are multiple theories which approaches this issue of the term structure, that why interest rate for different periods would be different. If we have the situation of uncertainty, then the shorter term instruments would be higher, because banks or investors are not willing to have a risk of so if they offer high interest rate for longer period, eventually they might be in the situation then they would overpay for having the loan, that on the open market they would have an option to borrow cheaper. But in the normal situation, the longer would be your borrowing period, the higher would be the interest rate, because in principle, the longer, the more risky, because during the longer period, more things might happen. Another important factor that affects interest rate and also the bonds, all bonds yields to maturity, bonds return, they all are related. So interest rate is related to this factor, to the inflation. Why we invest the money, one of the reasons is to keep the purchasing power of them. And inflation is the situation, then the purchasing power of the money goes down. So this is a normal situation, and it happens globally. The tendency that every year the purchasing power reduces. And in order to estimate the return that we have on any assets, in particular on bonds, we should make an adjustment for the inflation. So here we have an inflation in US. You see there were some periods then it was quite high, particularly during the 80s, 70s. But now it is more or less stable around 2.5%. In Russia, the scale, you see the scale is different, and if you would take this chart from the 90s, it would be above 100%. So there were a period then the inflation in Russia was more than 100%. So every year the purchasing power of the currency halved, or even went even lower. But recently, during the recent period, the inflation became stable. The prices do not grow that fast, according to the statistics. And this is a primary objective of the central bank, and they do their job here quite effectively. Here is the chart of the global countries by inflation rate. The darker it, the stronger the inflation. And in order to consider the inflation in our return calculation in bond, but this formula is applicable for other types of security as well, this is the formula. This is 1 plus nominal rate, the one we just worked with, divided on 1 plus inflation rate. It equals to 1 plus real rate, and the real rate is something that investors estimate. So how much money you earn on top of the inflation. Here is an example. If you invest in security that pays 10% interest annually, and inflation is 6%, what is your real interest rate? Here it is. it is 1.1 divided on 1.06. This is a real interest. No, if we subtract 1 from this ratio, we would have the real interest. And you see that real interest is 3.77. Here is the chart of the real interest rate on the 10 years securities or bonds in US. And you see that recently the interest on those securities, the coupon, is so low that it even doesn't cover the inflation. And this is due to the very high demand for those securities. That is why their price is quite high, and effective return you have there would be low, and so low that it even do not covers the inflation. So far, we discussed one type of risk, which is relevant for the bonds, but there is another one which is also very, very important, and it has a big effect on the bonds coupon. And this risk is called the default risk. And default, no, this is the risk that the bond issuer would go bankrupt and won't be able to pay the coupon and pay back the principal amount of the bond. And the higher this risk, the more expensive borrowing would be for this type of issuer. So the higher would be coupon on such type of securities. If you inspect some investment applications, Tinkoff, VTB, Alpha, or wherever you use, you would see, if you sort the bonds from the ones with the highest yield, you will see the list of companies that you probably are not very much familiar with, but they also can issue the bonds and you can borrow them, and they might offer you like 15% interest on the bonds or even higher. And this it means that they are quite risky. The risk of default for them is substantial. But how investor would estimate the risk of default? How we know that that the firm or some institution has higher chances of default or lower chances of default? Usually, we do it, but we use information by investment agencies. There are 3 famous global investment agencies: Moody's, Standard & Poor's, and also there is a Fitch investment agency. In Russia, we have a regional separate investment agencies, but the principle is the same. The higher the rating, the less chances of defaults, the cheaper would be the borrowing for this institution, the lower would be the coupon there. This is the grade of investment with the appropriate description. So the AAA, strongest ratings, very low chances of default. C is the bonds that have little chances to be repaid, so it is more likely to go default. And risk of the securities in the country depends on the risk of the country itself. Different countries, so country itself issues the bonds, and sometimes the bonds of countries also might be defaulted. And if the chances of such default are higher, then the country itself would be less risky. In Russia, currently we are in this B plus level, so the highest highest investment grade for the Russian company with the international scale would be BB+. But in the national scale, we might go for each of those companies, but those ratings would be issued only within the country for internal purposes. We might have this rating, but for international, they would not exceed this level. And why firms want to have better ratings? Because it allows them to borrow money cheaper. So here is some historical data on the coupon and the yield to maturity ratios of the different firms. And you see the better the rating, the lower would be the yield, so the firm would borrow cheaper. So this is alpha natural resources in the period of analysis had some troubles, and the price of this instrument were half to the face value. You see the price of the bond can be estimated as a percentage to the face value. It's easy to convert it, and you see it became half. It means that the chances of default are quite high. As a result, the yield is very high here, and it is getting very expensive for the firm to borrow the money, and it makes its operation more difficult because it has less opportunities to attract financing. Here is another chart to present the same idea. This is the recent information. There is it is a blue line presents the average interest rate or average yield to maturity of the 10 years corporate bonds with a rating BAA, and the red line represents the yield to maturity for the corporate bonds of AAA. And you see that these companies with the higher ratings always can borrow money cheaper. As they have less chances of default, they have this privilege to have cheaper sources of financing. And here is the final slide to discuss why companies or countries might fail. There are multiple reasons for it. Mostly the reason is in principle. Like the basic one is that the firm borrows or country borrows more than it can afford. So there is a term to service the debt. It means to pay the coupon on the loans, and if a firm has too high borrowing level, if the firm borrows too much, it might eventually become insolvent and unable to pay the default. And the country might borrow in a foreign currency or in the national currency, or it might borrow within the monetary union, like the one we have in Eurozone. And sovereign bonds is a term used for the bonds issued by the state. They are considered the less risky within this country, but still sometimes countries also go default. We had a default in Russia in 1998. Hopefully we will not have it again, but quite frequently some African companies, sometimes in South America, there are cases of default. Greece were close to the default some years ago, but was supported by Eurozone. So it happens. Then the entire countries fail on their borrowing with their bonds, and as a result, so financial markets remember it. And after such cases, they are less likely to purchase a bond of these countries, or if they do, they would demand way higher interest payments. So this is it. So today we discussed the bonds with you. There are two main factors: interest rate risk and default risk. The interest rate affects the prices of the bond, and the default risk affects also the price of the bond for the particular country or particular issuer. During the seminars, you will have a chance to practice it, to understand better what we discussed today.